Rakesh Arora, Managing Director and Head of Research with Macquarie Capital Security, joins us. Rakesh, good morning to you and fantastic to have you back. Let's talk about the market setup, and there seems to be a distinct shift in market behavior. Defensives are making a comeback, cyclicals are taking it easy. Numbers from pharma and IT have been strong, whereas engineering and energy has disappointed.
Yeah, I mean, it was bound to happen that, in a rally, some correction is definitely always going to happen. And it's a good sign that market is consolidating at these levels. Results for defensive companies was always expected to be good, given that they had so much of tailwind behind them. But the commentary coming out of cyclical companies is really encouraging also. Yesterday, Cummins was guiding to, 30% plus export growth, which has taken, I think, analysts by a little bit of positive surprise. So, the story is India's story. The stocks to own are cyclical stocks. There would be relief rallies for defensive names, but I think cyclical is where you'll make most of your returns in the next 2 to 3 years.
But which segment of cyclicals right now? Because there's much talk about autos picking up with the cycle recovering, and within autos is of course all that talk about the CV cycle picking up. Then you have infrastructure, you have power. Where is it that you're spotting a risk-reward opportunity?
Okay, so, while we are bullish on cyclicals, but we are saying that be skeptical about companies which are very highly leveraged and might need more than asset sale and deleveraging to really get out of this rut. So stock selection is definitely very critical even in cyclicals, but our preference lies for private sector banks where we see huge value still. So ICICI Bank, Axis Bank is what we are pushing quite aggressively. Among industrials, we are pushing high quality names like L&T, Crompton, Cummins, Adani Ports. So there's plenty to choose from high quality names still. And we are saying that, refrain from going into some of the very high leverage names like, Jaiprakash or GMR, GVK. Those kind of names should be avoided at this juncture.
In the report that you just came out with, Rakesh, I just wanted to touch upon, how you're looking. You've added Reliance Industries to your top 10 conviction ideas, replacing idea. What's been the story there? What's driving your conviction in Reliance right now?
Now, see, two things we are trying to play here. One is that idea was a telecom pick. But the telecom industry's fortunes are tied up with what Reliance Industries does in their own telecom venture, Reliance Jio, and that's why I thought that maybe Reliance is a better play on telecom rather than Idea. Number two is that analysts are already writing off the $8 to $10 billion investment which Reliance Industries has done in this telecom venture. So you're virtually getting this business for free. And number three is that there's also hope that all these oil and gas reforms which are happening would help Reliance. Plus, they are on verge of large capex cycle which starts yielding results from this year itself. So all these things combined, I thought Reliance, does make for a better case than holding to a pure vanilla telecom company. So that was the reason why we shifted from Idea Cellular to Reliance in our top 10 ideas.
Rakesh, let me throw the absolute winner for this year, and the absolute winner for this year from the Nifty is BPCL, up 70%. Are you surprised with the underlying price action in BPCL or for that matter OMCs?
Not really, because see, BPCL has a lot going for it. They did a big discovery of oil in Mozambique, and there's a similar potential in Brazil which people are talking about. So if you strip that off, BPCL is still trading well within the range it has traded on price to book. So BPCL we have been pushing for quite some time, and I think the stock has done reasonably well. But overall, to think of all the oil marketing companies, virtually we are coming to the end of all this energy subsidies, and even diesel subsidy is just 1.3 rupees per liter, short now. So it's a matter of 2-3 months that most of these subsidies are out of the picture, And this will allow these companies not only to reduce their working capital, but also, trade at, saner multiples where people can forecast earnings, etc., much more confidently. So I think oil marketing companies have already re-rated, and I think the re-rating will continue in the near future. There's still some scope for these companies to go up.
Rakesh, Indian markets or Nifty in this year has already appreciated by about 25% plus. Do you think bulk of the Nifty rally for this calendar year, is that over? Is that behind us?
I don't think so, because I think market, even the earnings have moved up around 17-18% during this year. So hardly there has been any re-rating which has happened, which normally we were expecting because of a stable government and, expectation of reforms. I think market can easily move to, 16.5, 17 time PE multiple. Currently it is at 13.5 times on FY16. So I think there's a long way to go before, we can say that the rally is over. I think we are just at the start of the rally right now.
And how much upside would you give to the rally then, Rakesh?
I mean, just assuming 15-16% earnings growth for the next 2 to 3 years, which is a very conservative assumption, we think that market should deliver at least 20% CAGR return for the next 3 years. So, it's very early days for the market, meaning we are coming out of a 5-year kind of, no return period, and we're just about breaking out of that range. So I don't think market has gone anywhere right now. There's, more returns to be made, and this is the time to really, invest on all kind of dips.
Right. You've also in your model portfolio replaced Cummins with Crompton Greaves. Now Cummins has come out with a strong set of numbers, and you yourself highlighted that the growth guidance has been revised, so there's some optimism there. Why this move then?
Yeah, see, basically, obviously this announcement by the company on the export front has also caught us by a little bit of surprise, and we would see consensus numbers on Cummins going up. It's not to say that we don't like Cummins. It is just that Crompton had much more specific catalysts which can play out over the next 6 months. They are demerging their electrical business, and we think there will be some corporate action out there, which makes it easier to play Crompton as compared to Cummins. But both the companies do benefit from improving economic scenario and export growth.
You're also shifting your weight from NTPC to Power Grid ahead of earnings. Of course, Power Grid is, in focus. Why this move? Because there is, of course, within the power sector, the focus is across the board, with power producers also, benefiting from potentially higher tariffs going forward.
See, the key idea was that one, NTPC has been hurt by the CRC order, and its ROEs have been reduced on a structural basis. Whereas if you look at Indian power sector, the major issue which is hurting them is actually transmission capacity, and we believe that Power Grid would overshoot its guidance on capex and actually is going to grow much faster, and that's why we thought that Power Grid gives you a little bit more edge in terms of growth from the next 2 to 3 year perspective. So better to stay with a transmission company rather than a power generating company for the next 3 years, and that is the kind of reasoning why we used to shift a little bit of weight from NTPC to Power Grid.
But within the power utility space, is one better off betting on private generators, because the upside for private generators could be unlimited if merchant power prices they pick up and if the real power demand comes back? In ideal situation that would be a logical conclusion, but the coal availability would be given to power companies who are going to do PPAs. So I don't think they will be able to benefit materially from any rise in merchant power tariff. To sell into merchant market, they'll have to rely on costly imports, and it doesn't really make that much of sense. So yes, they will benefit a little bit, but not as much as they could have ideally if coal was available from Coal India freely for all producers. Is TCS more like a no-brainer stock given the kind of numbers we've got from them and the kind of growth trajectory they've promised and indicated?
You're talking about TCS?
That's right.
See, TCS remains our one of the topics in IT space. It is consistently delivering higher than industry, growth rates, and it is already getting reflected in the higher PE multiple it is enjoying compared to its peers. And we don't see this thing changing. So TCS does remain, one of our preferred bet. See, when I'm trying to be, keeping a little bit of defensive portfolio, I want to keep the best stock in that portfolio. And TCS is indeed the best stock in that space. Meaning Infosys, HCL Tech can give you better returns, but they come with a little bit of risk at this juncture. And, that is what we like to avoid. So TCS is the top pick in IT space.
What about consumer names? And I'm particularly inquisitive about HUL. At 600, which was the open offer price by Unilever for more stake in the company in India, everybody said that the stock was expensive. But now the stock is at 700. Given valuations, given the growth visibility, what's the outlook on consumer staples, especially HUL?
See, consumer staples, we are massively underweight because these stocks are trading at a very high, valuations, and it will be difficult to really, generate significant returns from these stocks, and that is true for, Hindustan Unilever too. We have almost 600 basis point underweight on consumer staples, and we are recommending that you are better off shifting your weight to cyclical sectors like banks and industrials, which will give you much higher return. It's not to say that Hindustan Unilever is going to drop below 700 or can go to 450. That is not the objective we are saying, but it can, remain range bound between 650 and 750 for the next 2 to 3 years till the time, growth catches up with the valuations. So these stocks may not be able to give you significant returns, and better to shift to cyclical names.
Rakesh, can I just quiz you a bit more on that? Because, Nikunj and I were just looking at the year-to-date chart for HUL. It's done about pretty much the same as the market, the index. And while the valuation point is well taken, of course the market has been tilting towards cyclicals because there's more of a value play there. Having a core holding in consumer names would also benefit, because it's not like these stocks are not giving returns even as growth picks up. And if growth comes back in, then of course consumption is the key theme that one is looking at in India.
You're absolutely right. It's not to say that these stocks are going to destroy value. We are saying that they are not going to increase value at the same pace as some industrials or financial names can do. Secondly, remember that the economy really needs, job creation, wages increase before consumption can really pick up. So if this rally has to sustain, then, the manufacturing activity, the infrastructure built up has to precede the consumption pickup. So yes, we'll come to consumption plays maybe in a year or two, but initially I think the focus will be on beaten down cyclical names.
Prakash Industries, it was...
Just to give you one more example, that cyclical stocks are trading at almost a decade low as compared to defensives on valuation. So, there's a lot of catch up the cyclical stocks have to do before, we kind of reach on par value as compared to defensives.
Okay, let me just mark Prakash Industries down 20% in connection with that Syndicate Bank bribery case, and it has taken a further nosedive from 115 to 80. It's been a 30% drop for Prakash Industries, whereas Syndicate Bank, it corrected because of that bribe issue. Where the chairman was arrested by CBI for accepting a bribe of about 50 lakhs. And Syndicate Bank today has managed to bounce back, but Prakash Industries is down by about 30% in a matter of 2 days. ONGC is emerging to be the biggest star on the Nifty, and Sun Pharma is giving ONGC some company. Rakesh, Indian pharma companies have once again surprised at a time when the going was tough because of the currency. The companies like Dr. Reddy, Lupin, Glenmark, all of them have surprised with a strong margin expansion. Are you pleasantly surprised with the pharma earnings?
Yeah, definitely. Meaning, I think the direct linkage was with the US, sales volume growth for all these companies. And, for Sun Pharma specifically, the acquisition of Ranbaxy has come out at the right time when they are seeing some approvals come through. So, pharma companies, are doing well, and with rupee having bounced back to 60, 61, I think both IT and pharma, you can't be that much underweight as you were, like, say, 3 months back. The risk of rupee appreciating significantly has reduced dramatically because now there's expectation of an interest rate hike in US by, say, probably first quarter of 2015. So rupee is likely to be range bound at around 60, and that gives a lot of confidence on these names about their earning visibility, etc. And that is reflected in the stock prices now.
Rakesh, do you think the big realization from Q1 earnings season is that rupee is not a very big headwind for exporters? Everyone thought that just because rupee had appreciated and dollar had depreciated, most of the IT companies and pharma companies could report a sequential drop. However, what has come out is not a sequential drop. What has come out is a sequential uptick.
See, most of these companies do forward hedging, so it is not that a drop in one quarter will reflect in earnings immediately. So I don't think anybody was expecting significant drop in margins for these companies because of rupee. But now, given that, but there was expectation that rupee could go to 55, post elections. But that has not really happened, and that's why people are correcting their expectation on future earnings. Plus, they were going underweight on these stocks, so a little bit of bounce back has happened. But as I said, these stocks are all richly valued, meaning TCS is 20 times plus, so is the case with Sun Pharma, etc. For these stocks to give you 30-40% return is going to be difficult and very stock specific, whereas cyclicals can still give you 30-40% return, and that is where you should focus.
The credit policy is slated in some time from now. Could a surprise give a breakout to the market, Rakesh? If not in this policy, then going forward, is that the key trigger that will uplift sentiment?
See, inflation has been coming off and now stands at 7.3%, which is lower than what RBI's projected target for Jan 2015, which is around 8%. Government has been very proactive with trying to deal with the situation of slightly less rainfall and has taken action to control, food inflation. That should give comfort to RBI. Plus, also remember that RBI is now, has the benefit of having looked through the budget estimates, etc., and also have seen government in action for last 2 months. So they should be in a much better position to, see what kind of trajectory inflation can follow. If it is below what their, targeted projection is, they might give hints on cutting interest rate. So I think while expectation is not there of any interest rate cut as of now, but everybody is closely going to look at the language which the RBI uses, and probably there could be a rate cut before the year end, which is not a consensus estimate till now. Consensus still targeting for an interest rate cut next year. So I think that would be, the key thing to watch out for in today's policy.